Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. What is happening on the horizon? Last week on the show, we talked about trends. Today, we're going to talk about some clues in the news that real estate investors should be paying attention to on the Real Estate Guys radio program.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Welcome to the Real Estate Guys radio program. This week we're in Las Vegas, Nevada at the National Association of Broadcasters Convention, something we attend almost every year. I'm your host, Robert Helms. With me, as usual, our co-host financial strategist, Russell Gray.
Hey, Robert.
Las Vegas is always a fun place to come to.
We have a lot of memories from Las Vegas.
Every time in Las Vegas, the thing I think about is all those high-rise condos that got sold here, just one after the next after the next. I remember standing in line to put a deposit down on just to be in phase 2 or 3 of what would be 40 phases of a high-rise that sold out in 72 hours. It was craziness. And really, that's going to tie into what we're here to talk about today. We're not in Las Vegas because of the real estate market. We're here because we're at the Broadcasters Convention. And I've been coming to this convention almost every year for 20 years now, just to find out what's new in broadcasting. And of course, that's changing a ton too. But this week, we're going to talk about some great clues in the news.
We're the real estate guys. And so we come to Las Vegas for 3 reasons. One is the real estate. One is the radio broadcasting, and well, we're guys.
We're guys. Saying. It's a place. And I just read today that this place has a short memory. What happens here stays here.
Oh, so. Perfect. Exactly. So do I. I don't even remember what I just said.
So as you know, from time to time, we like to peruse the headlines. In fact, Russ does this all the time, constantly, because you start to get clues when you look at the news. And there's lots of sources for news. We look at a lot of what you might call alternative news sites, but sometimes those aren't exactly in favor with mainstream real estate investors. So most of what we're going to talk about today is right out of the mainstream news. And the reason that's important is it's stuff that you and people in your world are paying attention to.
Yeah, for me, that really is an important point because, if you're out there, especially we talk a lot about syndication. So if you're ever in the process of raising money or looking for credit partners or finding someone who is not familiar with real estate and the value add you're bringing to the relationship is I'm going to be the guy that finds the deals. I'm going to be the guy that puts the deals together. I'm going to manage the project or whatever. Then you are positioned as one of many options they have for their risk capital. And if you don't understand how they're thinking about the world based on what they're being fed from the sources they respect and listen to, then when you come with your story, it might be a great story, but they're filtering it through their paradigm and you might be telling it wrong, even though it makes total sense to you. See this happen all the time. So yeah, we spend a lot of time in the news for that exact reason.
So Business Insider came out with an article hot off the presses. New home sales unexpectedly jump in March. New home sales unexpectedly jumped, according to the Department of Commerce. Sales of new single-family houses rose 5.8% at a seasonally adjusted annual rate of 621,000, the highest since last August. And the article goes on to point out that economists had forecast new home sales would fall by 1.4% and were surprised when they actually went up. Now, obviously, more sales of new homes. These are brand new homes. That's a subset of all homes. There's existing home sales. Those are used houses, and there's new home sales. Now, also in this article, it goes on to say that the National Association of Home Builders Confidence Reading, every month they go and poll all of the home builders and they say, are you confident about the market? And they come up with a rating that's somewhere between 0 and 100. 0 meaning we have zero confidence. 100 means there's no one in sight. And in March, the home builders confidence rating remained near an 11-year high.
I remember when it was 7. Do you remember that?
Oh, yeah.
Right? 0 is no confidence whatsoever. 50 is your neutral. And I remember when it passed 10, it went down to 9, and it bottomed, I believe, don't quote me on this, but I'm pretty sure it was 7. You can't get too much more pessimistic than that.
Yeah, and so March 15th, it hit 71.
71.
The highest it's been in 11 or 12 years.
Yeah. And you think about that, what was going on 11 or 12 years ago?
Yeah, exactly.
I mean, this is the thing. You got to think about that. I mean, here we are in 2017. 12 years ago was 2005. Everybody was on fire. Everything was great. I was in the mortgage business back then. They were giving money away. That was the era of fog the mirror and get a loan. In some cases, I think I read articles about dead people getting loans.
Right.
And so you laugh, but this is what happens when you flood the market with tons of money. It needs to be placed, and people become desperate to create offsetting assets, right? You put money in a bank, and that's a liability to the bank. They've got to create an asset, which is a loan. We look at it the other way around. My money in the bank is the asset, and my loan is the liability, but the bank is on the opposite end of that transaction. So when that happens, people are out there desperately looking for ways to give money away. Well, when you're in the business of real estate development or construction, you're a consumer of debt. And when debt is free, it looks wonderful. What you don't understand if you don't pay attention, and I didn't back in then, I think today we understand it a lot better than we did, is that when money starts to become so free, so easy, so readily flowing, that it ends up being over allocated, or as Austrian economists would say, malinvestment, bad investment. It's money that ends up going aggressively into a sector of the economy based on it being cheap. Give you an example. We did a cash flow game on the Summit at Sea a couple of years ago. And during one of the modifications of the game, we lowered the interest rate to 0, which meant you could borrow any amount of money you wanted and not have any interest expense. Well, every time you turned over a deal card, it did not matter what the card was. As long as it was anything above 0, you bought it.
Yeah.
The problem is a little bit later, we raised the interest rates, and those investments that made sense at 0 cost of funds no longer made sense. And what we realized in playing that game is that when money is too cheap, investors and business people get sloppy. And when the price of money resets, that sloppiness is exposed. Now, I'm saying that's what's going to happen. But if you look back in history, you go, the last time there was this much confidence and this much easy money, people were malinvesting. And then you have to look around, that squish factor. Where's it going to come out? Where's it going to pop out? And how can we make sure we're on the right end of that?
I suppose we should point out that we do not have a crystal ball. We've been looking for one, but we don't have one. So the best we can do is study the past and look at where we think things are going. But the articles are a clue. MarketWatch came out April 21st and said existing home sales. So we just talked about new home sales.
And that's the much bigger segment.
Much more existing homes. Existing home sales hit a 10-year high in March as homes fly off the market. So again, these articles are both talking about the number of sales, not the price of the assets. Those are two different things. When we see people buying more, but prices going down, which we see at a dip, that's an indicator. When we see prices going up and sale numbers going up, this is the number of sales, existing home sales hit a 10-year high. You can imagine if we continue to see a demand for houses, that's going to drive up the pricing until some point when there's a change in the market. So this says properties were on the market for an average of 34 days in March. That is not very long. In the market you're in and the market you're familiar with, that might be an average time, but mostly across the country, we see, at least in the United States, an average more like 5 or 6 months in a normal market. At 34 days, that's a tight market, and sales of previously owned homes churned higher in March as sturdy demand for housing bolsters the market.
So here's the thing, because you have to take and put all these in a blender and try to work it all out and figure out how do they fit together. One of the things to pay attention to when you look at any market or any asset class, if you will, or product type, is supply and demand and absorption. And you can have a situation where demand spikes and then supply comes rushing in to meet the demand. But for a temporary period of time, you have a lot of demand and not enough supply. And so Economics 101 says you're going to see the prices rising. And of course, everything gets snapped up. And so you would see a scenario like that. If you're in the business of building, you look at that and you think, wow, that looks terrific. I'm going to rush in with my high level of confidence now because I've got cheap money. I can see huge demand. And that's great if you're the only one that does that. But if 1,000 other builders in the same market all do the same thing, when the pendulum swings the other way, what's that look like? And this is the key. Now you maybe get a bunch of builders who come in and build because the money's inexpensive. They're on thin margins, but that's okay because it pencils with cheap debt. Now you've got a glut of supply. Now what happens to pricing? So if you're flipping into that market, that's where you get in trouble.
All right, we'll talk about that in a minute because we have an article about that very thing. But why we're here on sales going up, just to paint some color, the national median sales price for the last 12 months is up 6.8%. So prices are rising and sales are rising. That's a healthy market. Now, again, we're talking about the national home market, single-family homes. Nobody invests in the national home market unless you're some sort of index or builder's fund. Instead, what we're talking about is regional differences, and we always say all real estate is local. Just as one example of that, regionally, sales surged up 10.1% in the Northeast, 9.2% in the Midwest. They ticked up 3.4% in the South, and in the West, sales fell by 1.6%.
Interesting.
So again, when we say the average isn't your market. You've got to study your market. We obviously can't cover every market on our show.
The favorite way I think of averages I actually learned from you, Robert, which is I have 1 foot in ice cold water and I have 1 foot in boiling hot water.
And on average,
I'm
I feel pretty
comfortable.
good. Yeah.
I'm guessing that would not be comfortable.
Now, the NAR chief economist, Lauren Schoen, who we've had on the show, called the first quarter of 2017 a good beginning, despite the ongoing headwinds of inventory and higher prices. See, for a long time, we're looking ahead at the supply. In fact, Aaron Adams last week on the show talked about the fact that we have a housing deficit on the way. We are not building houses at the rate necessary to keep up with long-term demand.
But here's the thing, and I don't have an answer or comment on it. I'm just going to throw it out because it just baffles me a little bit. Aaron Adams also said in that show that we have housing ownership, home ownership, at a 100-year low.
Yes, we do.
So who the heck is buying all these houses?
Exactly. Someone's buying the houses. Now, obviously, some of these homes are being purchased by homeowners, many of whom have been on the sidelines since the last crash. They haven't been creditworthy. 10 years later, they're starting to be. They haven't had great jobs. 10 years later, they do. The changes that are happening in the credit world, this isn't an article, but we've certainly recently discovered that there's some changes in the way that credit is reporting and what they're reporting because they're recognizing that the traditional FICO model cannot work when you have millions of people that got devastated in the last town.
Yeah, if you've got tax liens or certain other things, they're going to start coming off your credit report and not be counted in your scoring. So, after the financial crisis, the Dodd-Frank regulations came in. It was designed to make for more responsible borrowing, which, it was a euphemism for stricter lending. And at the end of the day, that ended up constricting the flow of capital. So, of course, investors step in. They come in with cash, and you've seen hedge funds do that and private investors. We've been a big part of that movement, at least in terms of concept, as proponents of syndication, getting Main Street savers to invest through Main Street entrepreneurs in Main Street projects. And so there's a lot of that going on. But if you got home ownership going down at a time where home sales are going up, either this is the start of a new trend and that's going to change, or there could be something else going on.
So what does that all mean to you? Well, it sounds good, right? Prices are up in existing homes and sales are up in existing homes and new home demand is great. What's the rest of the picture? Well, that's what we'll talk about as we continue Clues in the News. Today on the Real Estate Guys radio program, I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
If you want to retire in the next 5 years or less through real estate, then please pay close attention. My name is Brad Sumrock, and I've taught thousands of my students how to replace their incomes, quit their jobs, and retire faster than they ever thought possible by not investing in single-family homes. You see, there's a secret to retiring fast with little risk, and it has nothing to do with being a landlord, fixing toilets, or flipping houses. The secret is multi-family apartment buildings. Starting from scratch with zero experience, I managed to pocket over $1 million in cash and retire from my 17-year corporate job within 3 years of apartment investing. Now, this is not your typical no money down real estate training. We believe in smart, hard work for intelligent people. So if you're good with your finances, have a decent job, or saving your money, and you're looking for a change and getting out of the rat race, then investing in apartment buildings might just be the answer you've been looking for. Send an email right now to sumrock@realestateguysradio.com to get the details of my upcoming training event And you also receive my free training webinar, Apartment Investing for Beginners. That's Sumrock, SUMROK, at realestateguysradio.com.
Memphis is famous for being the home of the king of rock and roll, but it's also the king of cash flow. If you're looking for affordable cash flow properties, it's hard to beat Memphis. Get your portfolio rocking and more cash flowing your way by calling Terry Kerr at Mid-South Home Buyers. Terry's the king of turnkey properties. Contact Terry through the resource section at realestateguysradio.com. And be sure to order Terry's tips for turnkey rental property investing report. It's free. Just send your request to turnkey@realestateguysradio.com.
Hi, this is Anthony Melchiori from Hotel Impossible, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. I'm your host, Robert Helms. With me, as usual, Russell Gray here in Las Vegas, Nevada. We're talking about clues in the news. What is the market saying? And there's some good news out there, right? Existing home sales are up. New home sales are up. Prices are up. But that's not the whole story. 2 weeks ago at the Investors Summit at Sea, we started out with Dr. Doug Duncan, the chief economist for Fannie Mae. He had some very interesting things to share with us.
He did. And it was really fascinating because, we really thought that we had this guy coming in from Fannie Mae, and Fannie Mae is really in the business of helping people take out loans based on there being sunshine and a home being a good investment.
Right.
And of course, for the investors who are putting up the capital, that making the loan is a good investment. So,
And by the way, many of the people attending the summit were regularly customers of Fannie Mae with apartment loans and all kinds of stuff. So you're all on the same page.
absolutely. So this is a guy whose employer would prefer him to be pronouncing sunshine. And kind of like Lawrence Yun, right? Lawrence Yun with the National Association of Realtors, he works for people who want to sell homes. They want you to buy homes. So if there's a positive way to present the data, usually they're going to lean that way. So we were expecting that. And so that's great because we, fair and balanced. We're going to have Peter Schiff on the one end and, the end of the world is nigh. And we're going to have Doug Duncan over here saying, hey guys, everything's looking great. And Doug opened up and he said, with all his charts and graphs, typical economist speak, he said, this is the longest recovery, second longest recovery. In just a few months, it will be the longest recovery in U.S. history and also the weakest.
Right.
Which means just from a statistical perspective, just the odds that we are sailing into some form of a recession are high. Well, that wasn't sunshine. Oh, of course, it wasn't sunshine if you're speculating on things going up. If you're waiting for things to go on sale, it's a lot of sunshine.
Well, in fact, this article that we quoted in Market Watch about existing home sales, we actually mentioned in our current newsletter. If you haven't subscribed to the Real Estate Guys newsletter, go to the website at realestateguysradio.com, and it's free. Make sure you get our newsletter. It usually comes out weekly, and we don't sell your name to anybody, so don't worry about that. But we talked about this very thing, about the fact that, and we really started with our friend Simon Black, who was on the summit, who came out with his newsletter, which is one of the things I read every day, about the fact that the last time a particular thing happened, it preceded the big crash. It was 17 years ago when Charles Schwab new accounts were at an all-time high. Well, guess where we are right now? Charles Schwab new accounts in the stock market at an all-time high.
Highest in 17 years.
Yeah.
And 17 years ago was the dot-com bust, just before the dot-com bust. And so Simon's point, which was a great one, is that the way normal Main Street investing psychology goes, people wait until the market proves itself. And so they begin to buy in at the latter parts of a rally. And of course, they do it wrong because you end up buying high and then you end up selling low because once you've bought high and you start to lose, you're like, oh my gosh, I want to stem my losses. So you start selling and then it ends up self-feeding and it goes down and down and down. Then the professionals move in, buy the bargains and ride it back up. So you got pros on one end of it and you've got the novices on the other side of it.
So then we said, well, where else is history rhyming, so to speak? And that is that existing home sales hit a 10-year high right before the crash last time.
Yeah, 10 years ago was 2007, and that was right before 2008. So you've got people rushing into the stock market to own brokerage accounts and the stock market at an all-time high. And the last time that happened was right before the dot-com bust. And now you've got people piling into housing in the same way. Now, we're not saying cause and effect. We're not saying just because these things are happening. The last time it was interesting because when the stock market bubble burst, the money flowed into real estate and helped elevate real estate. This time, you've got both happening at the same time. So Peter Schiff says, yeah, well, that's because they printed all kinds of money and it's everywhere in the economy. And this time, when the bubble bursts, it's going to be all over the place. And so you guys might be listening to this thinking, oh my gosh, that's terrible. Well, what's the flip side of it? How many people do we know made millions upon millions of dollars, both in the stock market from 2008 to 2017 and in the real estate market from 2008 to 2017? From my way of thinking, one of the greatest gifts the market could give us right now would be a big pullback. If what you've done is realize where we are in the cycle and begin to get yourself ready. It's like what Donald Trump told us when we interviewed him before he was presidential candidate Trump, and when he was just the real estate guy, Donald Trump. We said, Mr. Trump, what did you learn in the downtimes? It's always good to have a little cash. Great. Note to self, make sure that you have some dry powder, especially when you're deep into a recovery and you start to see the mainstream. Robert Kiyosaki used to say this, when I go to the grocery store and the lady checking me out says she just got a real estate license, I know it's time to get out.
Exactly. When I used to teach the college courses, I would notice the size of the class, and it would range from 25 people to 85 people. And anytime we had 85 people standing room only in the classroom, it was the wrong time to get into real estate. And anytime the class was only 25 people, it was a great time to buy.
Yeah.
So the college real estate class metric says contrarian, right? So another thing came out, and again, we're not saying good or bad. These are the facts. U.S. home price growth climbs at the fastest rate in nearly 3 years. So this is an article about the S&P Case-Shiller Index, which is a 20-city index, meaning they look at just 20 particular cities. That index rose 5.9% in the 3-month period ending in February compared to the one a year before. So that means that prices are up. Prices continue to be up. So this is not bad. It's not good. It just is what it is.
Right.
Lots of people think we're nearing the top. Okay, there's still money to be made, perhaps. I think one of the big takeaways we had on the summit is we were talking about these very things and things like this. Hey, where are we in the cycle? And oh my gosh. And we had Peter Schiff, who has predicted 19 of the last 2 recessions. And we had, Dr. Duncan saying, hey, things are not terrible, but we're long into the cycle. And Peter and Doug having lunch together and actually getting along was astounding, right? It's just that we have to be careful in how we invest. I don't think it's a time to run scared. I think it's a time to be smart.
Well, I think, again, it goes back to how are you structuring your deals, and are you preparing a plan B? You've got to have a plan B. So there are a lot of people in this market. I mean, go to these contrarian indicators, if you want to call them that. How many house flipping shows are there on TV? How many house flipping seminars are coming through town?
Right.
You go back and look at Miami, poster child of flipping. And we talked earlier about being here in Las Vegas, and remember what was going on back then. People would tie up a condo in a contract and flip out of it before the thing was even built or delivered because they were just riding up. That was pure speculation. There's a difference, when you use the term flipping, people get confused. There's a difference between buying something, adding value to it by fixing it up, improving the management, changing it in some way, changing the use or the floor plan or doing something.
And selling it to a real end user at a profit.
Yeah. And there's another thing, having a hot potato property where, you're just, it's the market's hot, everything's going up, and you're going to buy it and you're just going to ride it up a notch and then get rid of it. And you hope when the music stops, you're not the guy holding that contract.
Right.
And what you can see is when you start to see some of these signs, you realize the music is slowing down. And it doesn't mean that you don't want to play. It just means you want to play the game a little bit differently. And that's where it really comes down to understanding your financing structures, making sure you have real customers, real cash flows, and that if you had to sit on that property for 10 years, you could. I had a conversation with a guy who was renting out a property, and we got into a conversation. His license plate said investor, and that's a cool thing. Let's have a conversation. And so it turns out that he and a bunch of buddies, had all California investors, had come into Arizona with their equity back in the day. Remember those days?
Sure.
So we were part of that crowd too. So they came in with their equity into the marketplace, and his buddies all bought a lot of property. They spread their equity to the wind. They were doing 10% down, 90% financing. They were controlling the property with marginal to negative cash flow and then hoping the property would go up and they're going to flip out of it. And for a little while they were doing it. They were crushing him until the market turned and they lost everything.
Right.
And now he's standing with 12 homes that are all paid for because he's got every one of them paid for. Now, I'm not saying I like leverage. I'm not saying that everybody should run around and have homes that are paid for. But what he had done is he built a portfolio that could withstand a downturn. And all I think we're saying after spending time with Doug Duncan, after looking at the news, is where you're at in your portfolio, the takeaway, because this is just a bunch of, babble if you're not looking at your own portfolio and deciding what you're going to do. But if you're looking at your own portfolio, you have to ask yourself, if my rents were to decrease 10%, if my equity disappeared and I was upside down, could I hold on? What if interest rates rose by 5 points? Will my financing structure survive that? Because all of those things could happen. And you may not be able to exit your properties as quickly as you like. The other thing is, if prices went way down, are you ready to buy? I mean, it's great to transition your equity out of an appreciated property, but if you just transition it into another overpriced property where the cash flow doesn't make sense, or in a market that's already overheated and you're not sure it's got much room to run, well, now all you've done is thin yourself out, but you really haven't bought yourself anything but risk. Whereas if you were to say, okay, I could do the same structure and maybe put a little bit of cash aside and wait, you say, yeah, but then that cash isn't working. Well, that's the way insurance is. Insurance doesn't work for you until it works, right? And when it works, you're awfully glad you have it. So cash on hand, liquidity, it doesn't have to be dollars in the bank. That has its own set of risks. But the ability to be liquid so that if all of a sudden a property across the street went from $200,000 to $100,000, and the property you're in still cash flows, even though it's only worth $100,000 and you got $120,000 or $130,000 loan on it, you're still okay as long as you're making those payments. But you can really do well if you can buy that house across the street.
Bingo.
You got to have some dry powder.
That very thing happened to us right here in Las Vegas, Nevada, when the prices went crazy down and stuff that was selling for way less than you could build it for, so far below replacement value. I was like, man, I'd love to buy 12 of these.
I had a high-rise condo here, $750,000. It was selling for $99,000.
I remember. I remember when I called you and told you that. Mine was $660 when I bought it, and you could pick one up for $110.
Yeah, I had about 110,000 reasons why we couldn't do that right at the time. And that's, really what folks, you're listening to us talk from experience. It's just understanding, the Titanic sunk because nobody thought it could.
Right.
Nobody prepared for that. They didn't even have enough life rafts for everybody because they thought it was impossible. They were really there for display. Nobody ever expected to need them. When they got the warnings for the iceberg, the guy said, hey, I'm just going to plow into it because I'm the man. Now, look, I don't know if that's how it went down. I wasn't there, but that, as the legend is. But the point is, it's very dangerous when you just, put your fingers in your I don't want to hear the bad news. It doesn't mean that it's bad. It's your preparation to what's happening. So to Robert, to your point earlier, the facts are the facts. The things that are being reported are being reported. The question is how are you going to respond to what you're hearing? And if something bad happened, do you have a backup plan?
Well, that's the thing, because this isn't bad news. All we're saying is if you look at history and it rhymes, when we've said things like this in the past, even on this show back then, we knew what happened next. It's Clues of the News today, what's happening and what that means to you as a real estate investor. More when we come back, plus we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Hi, this is Garrett Sutton, Robert Kiyosaki's asset protection attorney and the author of Loopholes of Real Estate and Start Your Own Corporation. As an American or foreign-based investor in U.S. real estate, you know we are a litigious society. You know that you need to protect your real estate, paper, and bullion holdings with the right mix of LLCs and corporations. Our firm, Corporate Direct, not only forms these entities, but importantly, we properly maintain them too. If you fail to follow the corporate formalities, you can lose it all in an instant. Corporate Direct is your source for LLC protection and maintenance in all 50 states. Visit corporatedirect.com or call 800-600-1760. Mention the Real Estate Guys for a free bonus. That's 800-600-1760 or corporatedirect.com. We look forward to assisting you at corporatedirect.com.
Hi, this is Patrick Donahoe, CEO of Paradigm Life. Wall Street and banks spend billions of dollars per year in advertising with the goal to convince you that they are the solution. But take a look around. None of their advice has worked. If you're listening to this, odds are pretty good that you're already a real estate investor, or at least becoming one. So why do you do it? Is it to hedge inflation, the tax benefits, or maybe it's to get your money away from Wall Street? It's because of these benefits and so many more that I created the Real Estate Investor's Guide to the Perpetual Wealth Strategy. When you combine successful real estate investing with the Perpetual Wealth Strategy, you have the recipe for what has helped the wealthy to establish their financial well-being for decades. You can download the Real Estate Investor's Guide to the Perpetual Wealth Strategy today by clicking the Resources tab on the Real Estate Guys Radio homepage. Don't wait, go download it now.
Hi, this is Bill Bonner. I'm author of Hormageddon, and I'm the publisher at Agora, where we publish more than 2.5 million readers around the world with the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. I'm your host, Robert Helms, here with Russell Gray in Las Vegas, Nevada. Hey, if you're looking for a market that cash flows and is well positioned for appreciation, then check out Indianapolis. There's a property and market tour you'll want to know about coming up in June. All the details on our website at realestateguysradio.com under events. It's clues in the news today. We're looking at headlines and what's beneath them and what specifically that means to you as a real estate investor. Before we get back to our articles, let's play real estate trivia. Your chance to win a prize by knowing today's real estate trivia question. In just a minute, I'm going to give you a question that has something to do with real estate. When you think you know the answer, quickly fire off an email to trivia@realestateguysradio.com. trivia@realestateguysradio.com. Include your name, the answer to the question, and your mailing address, because if you're the winner, we're going to send you out a copy of Robert Kiyosaki's great book, Second Chance. That can be yours if you know today's real estate trivia question. Last week on the podcast, we had Aaron Adams on the show, and we asked this. Charlotte is the largest city in the state of North Carolina and the second largest city in the southeastern United States. Which southeastern U.S. city is the largest? Well, number one, Jacksonville, Florida. Here's our real estate trivia question for this week. What is the widest river in the world? Many years ago, we asked about the longest river in the world, and it's about time we asked what is the widest river in the world. If you think you know, want to research it quickly, or just want to guess, send us an email to trivia@realestateguysradio.com. trivia@realestateguysradio.com. What is the widest river in the world? The first person with the right answer is going to get a copy of Robert Kiyosaki's book, Second Chance. That's today's real estate trivia question. We're in Las Vegas, Nevada. Happen to be here for the National Association of Broadcasters convention, but it takes us to Old Home Week because we were in this market when it was the fervor of the high rise, and every developer came out with a newer and nicer and better plan. And oh my gosh, we're being reminded of that at Clues in the News from an article. Now, we've been covering some Main Street news. This isn't exactly Main Street. This comes from Wolf Street, but it says, ballooning condo glut ensnares pre-construction speculators. Now, that article could have come 10 years ago, but it comes today. Miami-Dade's spectacular condo flipping mania is in turmoil, with sales plunging, inventory for sales soaring, and new supply flooding the market. And it's not like Miami hasn't been through this before. So in this article, it says in February, existing home sales of all types fell 10% year over year in Miami. And these sales do not include the multi-billion-dollar new construction condo market. So there's all kinds of projects. If you haven't been to Miami recently, what you'll see there is new high-rise construction, cranes everywhere. Seems like a positive market. Except when the music stops. See, we saw this happen in Miami before. We were doing Miami field trips looking at this various inventory, and it happened right here in Las Vegas where all these great looking projects came out, but there was no strong foundation of economics underneath it.
Well, and this is the thing. I mean, because it wasn't like we were completely stupid. We were paying a lot of attention. We were looking at how many driver's licenses and how many people were moving in. We were plugged into all the people that were reporting the economic stats. We went to the annual conference and got all the details from the people. And it seemed like, gosh, we are adding an awful lot of hotel rooms. And is it really possible? Could this growth really continue? And we were persuaded that it could. We were listening to people who believed it could, that found facts that supported the conclusion. And we all lapped it up because it's what we wanted to hear. Here's the question that we weren't asking and no one was addressing. What happens if it doesn't?
Right.
Oh, well, that could never happen. Okay, I get it probably would never happen. But let me just ask you, what if it did? Right. Do you have a plan? And our answer was, we don't need a plan. I mean, most of the people, we don't need a plan. There's no plan. I mean, this is brand new. We have no idea. We're sailing into uncharted territory, but oh my gosh, look at this and the economy and everything going on. Well, sure enough, the unthinkable happened. And, we had the biggest financial crisis in our lifetime. No one saw it coming that, in our world, that's why we started hanging around with Peter and guys that did pay attention, because next time we don't want that to happen. We want to be paying attention. But there were people that were with us in that market that did have a plan. They structured it in such a way. They didn't look like they were crushing it like some of the rest of us, right? But they ended up being able to hold on. And 10 years later, sure enough, those prices have come back. And so there's a lesson in that.
Well, now they haven't come all the way back. And the other thing about that marketplace is at the time, there was a lot of that greater fool theory that you spoke of. Flip out of it at this and I'll sell you my contract before it closes. And that was going on like crazy. And then when it went down, based on absorption, I remember sitting at a seminar here in Las Vegas, hearing about the housing market and that we had a 432-year supply of high-rise condos.
That's a problem.
Based on the current absorption. Not only that, in those buildings, 9 out of 10 owners were not paying their HOA dues at all. Now, you know what? If 1 out of 10 isn't paying, you can probably skate by. But when 9 out of 10 aren't paying the dues that go towards the current obligations, the future obligations, the common area maintenance, that's a problem, right? Most of these buildings had elevators. Those have maintenance contracts. If you can't pay the elevator maintenance contract, how do you get to the 47th floor?
Yeah, this is the thing. It goes back to what we were saying. It doesn't just have to be condos. It's any market. When you have a temporary spike in demand, and this was caused by a lot of free money and a lot of enthusiasm. We had a lot of equity in other markets flowing into affordable markets. That can be a good move, and there's some of that going on right now. And the only reason we're kind of bringing this to everybody's attention is just because there's so many things going on in the news right now that feel very similar. We're not saying it's going to happen.
No.
We're not saying that at all. Now, we're saying if it did happen, we'd be happy because this time we're prepared for it.
Well, I think it's a wake-up call to say if you're not prepared for it, there's some things you can do. Before we're done, we'll talk about what some of those things are. It's Clues in the News today, what's happening in the news and what that means to you as a real estate investor. We love to do this kind of show every, 10 or 12 weeks. And we get a whole pile of news articles that seem to make sense to us. Hey, we'll have more when we come back, including a really interesting one next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Are you ready to profit in paradise? Hi, it's Robert Helms, and if you think real estate investing means tenants, toilets, and termites, think again. Located just a short plane ride from the U.S., a virtually untouched paradise awaits, the beautiful country of Belize. When you go to Belize with the Real Estate Guys, you'll spend 4 fabulous days discovering one of the most intriguing real estate markets I've ever seen. With its jungle rainforests, pristine beaches, and 81-degree turquoise water, Belize is one of the most beautiful places on earth. Plus, it's considered one of the top 7 tax havens in the world. Belize property is on the rise, and many experts think the best is yet to come. But don't just take my word for it. Come experience Belize firsthand at our upcoming investor field trip. When you join us, you'll discover the many reasons we love Belize, like tremendously undervalued beachfront land, super low taxes, ease of doing business, and so much more. Get the details at realestateguysradio.com. Just click on events. See paradise for yourself. Click events at realestateguysradio.com, and I'll see you in beautiful Belize.
Hi, I'm Mark Victor Hans. You're listening to The Real Estate Guys. If you want to expand your consciousness, expand your wealth, expand your future, and have more delight and excite in your future than in your past, keep listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, if you have a question for the Real Estate Guys, we've got an Ask the Guys episode coming up soon. Get to the website at realestateguysradio.com and click the button that says Ask the Guys and fire away. We love to answer your questions on the radio. Hey, we've got another article for you, and this one is quite different than the ones we've been talking about, but as a real estate investor, have your listening ears on.
Yeah, so I'm perusing the Financial Times, and I see a headline that was reprinted from a publication called Nikkei Asian Review. This is about the Asian stock market. And it is dated April 22nd. It says, robots can handle a third of our workplace tasks, study finds. So it's McKinsey & Company, famous consulting company, and they had done a report, and it said their information shows that apparently they've identified 77 processes that can be handled in this engine assembly line, and of those, 58 of the 77 or 75% can be automated. So that's putting people out of work, right? Yep. We've already heard about what's going on with McDonald's and Wendy's putting kiosks in. These were the entry-level jobs for college and high school kids, their very first job. My first job was, selling and cooking donuts at Winchell's. Those things are automated today. That job wouldn't have existed. So the skills, the work ethic, just the pride of having my first job, that doesn't exist for a lot of our young people. So that's one issue.
Well, then driverless cars, right? Pretty soon. And in fact, right now in several markets, you can get picked up by a car with no driver in it. Kiyosaki is big on this. He's been talking about this. Last time we had him on the show before the summit. On the summit, he's talking about this very thing. And so think about how this impacts your tenant. if you are the kind of landlord that provides rental units to people that work at Winchell's or Wendy's or wherever, right?
Whataburger, anything with a W.
Right, anything. Yeah,
The
exactly.
W. They could work at the W, but
They
that's not a
could.
fast food place. No, so this morning, I'm on the way to the airport. I call up a Lyft driver, and he's got an Uber thing. So he's Lyft and Uber. And I always ask these people, which do you like better, and get him talking. So he's from Kenya, and he came here about 7 years ago because, he wanted a better life, and his cousin was here, and all that was interesting. So I said, do you do this full-time or part-time? Well, it's part-time. What else are you doing? I'm going to school to learn computers so I can go be a tech guy. It's great. So this is his only source of income right now, even though it's only part-time. And I sat there thinking that because I had just read an article that morning where in Phoenix, the market that I was in when I'm on my way to the airport, they are already doing the trial where you can just order up a driverless car and you pay and it drives you. So that guy's job goes away. I asked him, do you own or do you rent? I rent. He is somebody's tenant.
Yeah.
And when his job goes away, that somebody, that landlord, is affected.
You came in from Phoenix?
That's the point. I did.
I wonder if he's my tenant. Well, here's the point, right? We have to be thinking about how every change and everything we hear about is going to affect us, good and bad, as landlords. I mean, that's it. There's some great things coming. The fact that we're at a 100-year low of home ownership means that there's more renters than there have been. That's good for landlords. But when you hear about jobs being lost, entry-level jobs, which is a lot of our tenant base, that's something to be aware of.
So here's something completely out of the box. You're going to remember this because this was so bizarro to us when we saw it. But I was looking for more information about these driverless cars, and I found a company that is saying they're going to beat Uber to having flying cars. And those flying cars will be ready by 2020. Well, it was probably at least 10 years ago.
It was 12 years ago.
12 years ago.
That we had a few students of ours.
We had some students of ours come to us with a pitch to go buy abandoned airfields.
Right, mid-level size airfields and small
airfields that had just fallen into disarray. Nobody had any purpose for them. They had no use. It was like, what do you do with this?
Pennies on the dollar.
You can pick them up for pennies on the dollar. And they said someday in the not too distant future, there's going to be flying cars and there's going to be a market for these little micro airports. And we just looked at him and we thought,
I'm not sure we can wait that long.
What? I mean, wow. But, here we are, right? So sometimes, you do want to have, we had a guy working with us who would always go to the Future Conference and he would come back and he would tell us these things and you're like, wow. And you look at them and now they're beginning to happen. And so I guess the lesson is that it's not just economic or doom and gloom. I mean, we have an aging population. That's a fact. We have a huge generation of millennials coming up in record amounts of student debt. That's a fact. That is affecting their behavior. It's affecting their ability to purchase things. Interest rates, being controlled by what's going on. We talk about the Fed all the time. And there's all of these factors that we talk about constantly that affect the universe or the ecosystem, I call it, that you're investing in. And there's wind blowing that moves quickly and you got undercurrents going on and waves and swells and storm clouds forming on the horizon. So as you're navigating your portfolio through these changing circumstances, it's important to pay attention. We have an old proverb in our quote section on our website says, a smooth sea never made a skilled mariner.
Right.
I'm very thankful for 2008 today. I wasn't thankful at the time, but getting my rear end handed to me the way I did, it made me a better student. It made me sharper. I sought out smarter people. I read more books. And I really honestly can tell you, not only am I not afraid of a downturn, I'm actually looking forward to it. And I remember when Kiyosaki used to say that to us. And I thought, this guy's crazy.
Right.
I mean, why would anybody wish that? But when you realize all it is a sale for people that have purchasing power. So it's really not that complicated. It's like, okay, when it's sunshiny, then get some chips off the table, park them somewhere where they're safe and get ready for the sale because the cycles are certain to happen.
Well, there you go. That's the whole thing is what do we do with all this? What can you do? Well, the first thing, the good news is you're already doing it. You're paying attention. Most people don't make it this far through our podcast. Right? They don't. They have short attention spans and they're on to the next thing. So the fact that you're even listening is great. It means you're paying attention. Continue to do that. And then watch the trends like we talked about last week on the show and watch what's happening in the news and decide, what does that mean to me? How does that affect me? How does the person driving Uber or Lyft losing their job affect me and my portfolio? It might not. But if it does, what are some proactive steps you could take now? Could you diversify across product type? Could you diversify across market? Could you diversify across hold period? I mean, there's all kinds of things you can do. There's the income side, there's the equity growth side. There's building up your balance sheet, there's building up your income statement. These are the things to be thinking about. And when the sun is shining, that's the best time to repair the roof.
Oh, yeah, that's the time. The best time to borrow is when the banks are lending and you don't need the money.
Yeah.
The worst time is when the banks aren't lending and you do need the money.
You got that.
So all you have is the cost, the premium you're paying for the money while you've taken it. Well, today that premium is very low because interest rates are so low. Simply says, yeah, but you're losing money. No, you're paying an insurance premium to be liquid in the event of a crisis. And without too much clever risk taking, you could probably find a way to earn enough money on that capital and still be highly liquid that your cost to hold and be liquid is fairly negligible. But what happens is if the market goes down and your equity goes away, it goes away. If the stock market, which is 20,000 plus today, all of a sudden you wake up one day and it's 12, all that liquidity you thought you had, it's not there. I remember when I had home equity lines of credit and lines of credit and credit cards, and I thought I had all this liquidity, and within 2 weeks it was all gone. I hadn't done anything wrong. I was still making my payments, but they didn't want to take the risk. They knew what was coming because they were looking down the horizon. I wasn't. And so there's just lots of things out there for you to be thinking about, and it starts by, to your point, Robert, listening, asking the questions, and then getting around other smart people. That's why we do the summit. Now, of course, it's too late to convince you to come on the summit, at least for this year, because we just did it. But we're going to do it again next year, and it's going to be bigger. It's going to be better. I mean, we've got huge plans. We're not marketing it yet, but you can go to the website at realestateguysradio.com, click on the button that says Summit at Sea, and get on the advance notice list. This year, the alumni took a big chunk of it. And then what ended up happening is we only had to put out 2 emails, I think. I mean, we always had the talk on the show, the ads and stuff, but we only put out 2 emails to our list, and then we're basically sold out with nearly 200 people.
Yeah.
So this year, I think we got a huge alumni re-up. So there's probably even less spaces available, depending on what we can do to open things up. But believe me, you want to be on that waiting list if you seriously think you'd like to be on the summit. And if you're a serious investor, I can't imagine any place better to be.
And there's other places we'll be as well. So check out the website at realestateguysradio.com and click on events. Sometimes it's our events, sometimes it's other folks' events. We've got an event coming up we're going to be at in Las Vegas, Nevada, and an event we're going to be at in Bozeman, Montana. So we scour the globe. And of course, we'd love to have you come out and meet us at an event. Hey, big thanks to all the folks who work hard to bring us these articles that we love to peruse in the news, because those journalists are working hard for somebody. And your job, like our job, is to interpret what that means to us. It's not doom and gloom. It's not the sky is falling. It's, as the Boy Scouts say, be prepared, and it will all look better for you. Until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors. From attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.